Hello everyone, welcome to session 5 of SCMPE revision. We are now starting with the next topic, transfer pricing. So transfer pricing, as you know, the basic concept, it is the method and the technique and the negotiation based on which we are going to fix a price for the transfer of components or parts from one department to another department. Here, we are not fixing the selling price because there is no third party involved. It is within the organization. This chapter tells you the different methods, different techniques, different ways of fixing the transfer price. Transfer price is the price at which goods are transferred from one department to another department, transferring and receiving department. So basically, there are three methods of fixing the transfer price. Number one, cost-based. Cost-based transfer pricing using cost or any variant of cost with or without keeping any markup. What does that mean? That means suppose there is department 1, there is department 2. For ease of understanding, we will keep this for this entire topic. Department 1 makes the component and they have to transfer it to department 2. Department 2 will assemble it. Now the receiving department is D2, giving department is D1. Now whatever is the cost incurred by D1, the goods will be transferred to D2 at cost itself. Now they said any variant of cost. So now when I say cost can be many things. Can be only variable cost, can be total cost, can be total cost plus opportunity cost, can be only manufacturing cost. Cost can have many variants. We will discuss all of that. But here, whatever we spend, only that cost is recovered. We are not adding any markup. We are not adding any profits. As I told you, different variants of cost, variable cost, full manufacturing cost, total cost, or even standard cost. The merit of this is simple to understand, easy to calculate, and guarantees full cost recovery to department 1, the one that is transferring. They know that they will recover full cost. Demerits, it is not suitable for performance evaluation. At the end of the year, you will not get to know which department is performing well. Have we spent more? Have we spent less? Which department to be given reward recognition for good performance? Because there is no way you can measure the performance. Whatever they spend, they transfer it at that cost. Second, it ignores opportunity cost. Third, it does not reward any cost efficiency. What does it mean? Suppose one department is saving a lot of money to the organization by their cost control and cost reduction technique. You are not going to recognize that work at all in any manner. There is no bonus, incentive, nothing paid. Suppose if there is a price-based transfer and not cost-based transfer, then you will know that every department or every process can book some profits. They can say that, look, we have sold it at this price. We have sold it at this price. Our cost was this last month. This month we have sold or transferred at this price. Our cost has come down. Our profit, department 1 profit has increased. Give me some incentive for reducing the cost. So that guy, the head of department 1, can come and demonstrate that he is, he should be given. He deserves some recognition in the company for whatever work he is doing. But if you go by simple cost basis, whatever cost he spends, at that number, that amount itself, he has to transfer to next department. He will not gain anything. He means the owner of department 1. So this is the demerit. On the other side, market price based transfer pricing. That is, the cost incurred by department 1, say, is ₹9. This component is available in the market at 11 rupees. Now, if you go by category 1, then from D1 to D2, it will go at 9 itself, cost based. But if you go by category 2, then it will go at market price that is 11 rupee. Here one advantage is department 1, they can either sell it outside or they can transfer it to department 2, but they are happy because they are getting market price whether they sell it inside or outside. See this here, market price of the intermediary product as quoted by outside supplier, market price of substitute if there are any. Okay, if this item is too costly for the receiving department, can they go by an alternative? If yes, which is that alternative item? What rate? If that is available at 10.5, then 10.5 can also become a transfer price. Merits, lot of merits. Number 1, maximum prices. The department 1 will not now cry that look, I am doing so much, I am not getting any reward, any recognition. You will surely get reward, you will surely get recognition. How? Look, you are spending 9, you are transferring it at 11. We will not change the 11 because 11 you already have the profit. But if you reduce 9, make it 8.7, 8.5, then you can show the difference, the additional difference also as your profit. And on that you will get 10% bonus. The company can come up with some bonus and incentive plan because they are going to make some profits, both D1 and D2. D2 obviously will make profit because they are selling it to outsider. Now even D1 is motivated to reduce the cost to show more profit, called inter-process profit or departmental profit or divisional profit, the difference between the transfer price and the cost. And he can also quote a higher price if in the market the component, suppose I said 11 rupee. What if in the market people have increased the rate to 12 rupee? Even department 1 now can ask for 12 rupee. That is our next method. You see, negotiated or bargained price. Now both will sit, discuss and decide. It is not simply go by market price. Second, demand and supply. What will D1 do? That depends. Department 1 action will be based on market factors. In market, there is huge demand. People are ready to pay 11.5, 11.8, 12.1, 12.2 also. Now department 1 will say, boss, department 2, I told you I will give you at 11 rupee, but in market people are ready to pay me 11.3, 11.5, even 12 rupee at times. I'm going to sell it there. You buy it from outside, I don't know. Now department 1 is more powerful. But here department 1 is thinking about themselves. That will come in the demerit part. Opportunity cost recovery. Exactly, that's what I told you. If I sell it outside, I can sell it at 11.3. Why should I give it internally at 11? I will recover that 0.3 also. I will ask even my internal customer, that is department 2, to pay me 30 paise more because I'm going to get it if I sell it outside. Now there is more power to department 1, understand. Yes. Next one, the main objective, the profit maximization is achieved. And because everybody wants to earn more profit, every department wants to show more profit, everybody will try and reduce the cost. Everybody will try and reduce the cost, and that is the ultimate objective for any organization. Availability of market prices. The biggest demerit is the price available? Do we have the correct information? Suppose division 1 makes tires. Division 1 is making tires. Division 2 is assembling all the parts and they make cycles. Now tire is getting transferred to cycle division, department 1 to department 2. Now tire can be sold outside also. There is a market price also. If the market price is available, then we can consider that even in method 2. What if market price is not available? Now you may ask, sir, how is it possible that you are not able to get market price? Tire is a marketable product. It is not some restricted product. We can get the market price. You can get the market price, but the problem is the quality of your tire and the quality of all other tires available in the market may not be same. And when the quality is not same, comparing your price with their price may also not be correct, and that's the challenge. May also not be correct, that's the challenge. Market price is available, but is it an appropriate market price to consider for internal transfer pricing may not be, because there are issues with quality. Second, impact on selling and distribution cost. Imagine if department 1 says that, boss, department 2, you have to give me market price, otherwise I will not sell anything to you, I will sell everything only outside. Now if department 1 says I will sell everything outside, they will have to incur a lot of selling and distribution cost. So far, when the tire was going to cycle department, it was from one room to another room in the same big factory. There was no selling and distribution cost. But now that the department 1 has to sell tires to outsiders, customers, then there will be external packing, secondary packing cost. There will be distribution cost. You will have to have sales team, marketing team, and you have to then give them commission incentive for selling more and more tire. Now this has become a new cost to the company. So far they had selling and distribution cost only for the cycles. Now they have it on even for tire distribution, which was not there earlier, but now it is there. When you were in cost method, that was the first method, department 1 would never say I will sell it outside. So there is no possibility of additional selling and distribution cost, because there was no additional selling opportunity itself. But now you have an opportunity, additional selling opportunity. And now that there is an opportunity, that comes even with the cost. You can sell outside, but selling outside has a lot of additional selling distribution cost. Unjust enrichment, I told you already. Department 1 becomes so powerful that it can even blackmail department 2 and say, I will not give you unless you give me the price, the prevalent market price. And what if department 2 is not in a position to pay? Now department 1 may misuse their powers, correct? And the problem is, internally you will create more conflicts between department 1 and department 2. The managers of department 1 and 2 will start disliking each other. Why? Because department 1 wanted to sell at a certainly higher price. Department 2 is not ready to pay so much. Now management has to come in between and sort out the issue. One of them will be unhappy shortly. You will unnecessarily create conflicts in the organization. So to avoid the conflicts in the organization, many companies follow the third method, which is bargained or negotiated transfer price. Now what happens? Department 1 comes with a price that, look boss, I am ready to sell at 11.2 rupee. This is the quote given by department 1. Department 2 says, boss, maximum I can pay you 10.5 rupee, nothing more than this. Now they have to come, sit and discuss and negotiate. 10.5, 11.2 is your range. Management is also involved. All three will decide, will discuss and come to a final transfer price. Yes, it is actually a combination of category 1 and category 2. How is it category 1 and category 2? When department 1 says 11.2, on what basis he is quoting this number? Because he knows this is the market price. He says, if I sell the tire in the market, I can get 11.2. I will not give it to you, dear department 2. I will not give it to you at less than this. Why department 2 is saying, give it to me at 10.5? Because department 2 knows the cost of department 1, cost of making a tire is only 10.4 or 5. Therefore, they believe your spending cost, you recover the cost and give it to me, because ultimately we are one company. Our company's main product is not to sell tire. We are known in the market as cycle seller. Therefore, you should not target profit so much. You should help me, department 2, to make the better cycle and sell, improve the quality of the tire. Don't try to make too much of profits. So you should give me at cost itself. But then department 1 will not be happy with the proposition of 10.5. Now this is department 2 is asking the transfer to happen at cost, where department 1 knows that it can be sold at 11.2 in the market. So they are asking for the price. That's why it's a combination of 1 and 2. Merits, proper decision, autonomy and motivation, and optimality. Here one good thing is, both of them and management, all three parties will have to sit, discuss. Now you need to create a win-win situation. Now this is not easy. This is not easy. Now 10.5 is not acceptable for department 1, 11.2 is not acceptable for department 2. Now if you discuss, if you bargain, finally come to one number, say 10.9. It may be okay for department 2 also, because he is getting some saving, because otherwise department 1 would ask 11.2, now it is 10.9, 0.3 saved. Department 2 will also be happy, okay, they're not getting 11.2, but they're still getting 10.9, which is higher than 10.5, which otherwise department 2 was talking about. So in a way, you bring both of them together and try to sort out the price difference issue, and it may motivate both of them to purchase internally. And remember, D1 cannot be too stubborn and say I will sell only at 11.2, because department 2 can also bargain outside and they can also buy tires from someone else. And if they are getting it at 11.1 also, they will buy from outside itself. They will buy from outside itself. You know when will the problem comes? If they are buying at 11.1 from outside, then department 1 will say, that's okay, I will go and sell everything outside. The problem is department 1 may produce 1 lakh tires, but they can sell only 75,000 tires. What about balance 25,000 tires? Are they at least ready to give that to department 2 at 10.5 rupee price that department 2 was asking earlier? This is where the negotiation comes into picture. So then they will agree to 2 prices. Okay, dear department 1, if you are able to sell it in the outside market, then there is an opportunity cost. Do one thing, consider variable cost plus opportunity cost, transfer it at that price to department 2. If you cannot sell it at outside, you cannot sell it outside at the market price, then you please give it to department 2 at your variable cost and add 5% markup if you need. Now by this, both D1 and D2 will be somewhat happy, but I know the demerit first one, suboptimal decision and conflict. Suboptimal is when individual departments are thinking about themselves more. It is easy to say that the management will come and sort out this difference. It is not easy to sort out these kind of differences, because everybody is thinking about their own performances. They're not worried much about the overall company's profit. This is where the conflicts come into picture. No scope for performance evaluation. Why no scope for performance evaluation? End of the month, if management say, department 1, why are you not able to achieve good profits? Then department 1 says, boss, you are the one who is asking me to sell the tire at lower than the market price to department 2. I was not ready. I wanted to sell everything at 11.2. It is you who convinced me at 10.9. Not convinced, forced, because you are management. You are forcing me to sell at low price, and then you are questioning me end of the year. Why am I not able to achieve profits? It's because of the management itself. They will easily escape. Then management cannot assess the performance at all. They can't even ask department 2, why is your cost so high? Then also department 2 will say, you are asking me to buy at that rate from D1. You are asking me, you are fixing the price. Don't ask me why my cost is more. Time and cost. This negotiation takes time. They may not agree immediately. May take weeks together, because both of them, D1 and D2, both of them are focused about their individual performances, individual profits, and they're not worried about company's overall growth. And that's where the problem comes. Yes. Next, criteria for setting transfer prices. Number 1, achieves goal congruence, cost base often but not always. Yes, if market prices are competitive. Yes, always. What is achieving the goal congruence? Goal congruence is your individual department's goal. Is it in sync with the overall management? If that is happening, then yes, we have achieved the goal congruence. And most of the times the problem comes here itself. What department 1 wants may not be what the total company wants. Second, motivates. Yes, if based on budgeted cost, there is less incentive to control the cost if transfers are based on actual cost. How do you motivate department 1 under cost-based transfer price? You set a budgeted cost. Budgeted cost is 8 rupee. per unit. Example, forget the previous numbers, a new example, 8 rupee. Now, how will you motivate department 1 manager even under cost based? You say, look, boss, you will transfer throughout the year to department 2 at a budgeted cost of 8 rupee only. Now, what is the motivation for him? If the actual cost is only 7.6 rupee, that is because of department 1 manager's efforts. If he reduces, controls the cost very well, then he can go to the management and say, look, I'm saving 40 paise from each unit. From each unit, I'm saving 40 paise and I have transferred 10 lakh units. That means I've saved 4 lakh rupee. Give me incentive or bonus. This is possible only if he can transfer at budgeted cost. But if he has to transfer at same actual cost of 7.6, then there is no motivation at all. Market price, definitely yes. Negotiated, also yes. Third, useful for evaluating subunit performance, that is divisional performance. Difficult because they're just transferring everything at cost. Here, yes, it is possible if market prices are competitive, yes, but the transfer price is affected by bargaining strength. Now here, in third one, they said you can evaluate divisional performance at the end of the year, even under negotiated pricing, but that depends on which department bargains hard. That means your focus is now shifting from reducing and controlling cost to bargaining well with the management and other departments. Next one, preserve subunit autonomy. No, because here that department 1 has no independence at all. You're just telling him, boss, whatever you spend at that rate you transfer. Where is the autonomy? Where is the independence to that department? Second and third, yes, because in second and third, first we'll talk about the second. In the second method, which is market price based transfer pricing, the department 1 has the power to go to department 2 and say this, look, I will not give you the product unless you give me so much price, because in the market I can get it at this price. That means they have the power to bargain. Third, definitely, because here they will quote a number D2, department 2 will come back with another number, they have to sit and negotiate. Now we are making D1 and D2 both are powerful in second and third, because both can decide whether to buy internally or to buy from outside. But in first method, where everything is transferred simply at cost, there is no autonomy. Other factors, it is useful for determining full cost of the product. No market may exist, or market may be imperfect or in distress. So that's where the challenge comes. You will not be able to use this method. Bargaining and negotiation takes time. I already told you this, and this may need to be reviewed repeatedly as conditions change. Every month, if department 1 and department 2 are bargaining, are quoting different prices, every month management cannot sit in between them and try to sort out. Then this will drag it further forever. Yes. Yeah. So that was the discussion on all the important theoretical concepts. In fact, I think May 2022 question paper, and maybe even in November 21 question paper, there was a question on transfer pricing. Once they asked a theory question itself, which are the different methods of setting the transfer price, list out the advantage and disadvantage. Again, the question was not 2-line question, a story ended with this. Normally what they do, they create a detailed explanation. There are 2 departments, they do this. There is no motivation because as of now they are following cost-based system. They are now thinking of either market price-based or bargain-based. You as the cost accountant advise them, explain them the difference between all the methods, advantages and disadvantages. So you need to know the whole story and then write this table and then connect the points of this table to the relevant case and complete the answer. Yes. Next discussion is budget and budgetary control. Budget is a financial and/or quantitative statement prepared and approved before a definite period, may include income, expenditure, and usage of capital. Very basic definition. What is budgetary control? Process by which budgets are prepared for future period and compared with actual performance for finding out the variances. Important here. Budget is merely a statement of future activities. This will happen, that will happen, we should do this, we should do that. In rupee term or in quantity term, very easy. Budgetary control is continuously reviewing that, continuously checking that, continuously following it up. Once in a month, once in a quarter, once in a year, and review what was supposed to happen, what has actually happened, why is there a difference. This is called budgetary control. So budget is a part of budgetary control system. Understand this way, budget is a part of budgetary control system. Managers set financial and performance goals, compare the actual result with the budget, adjust the performances as and when needed. Prerequisite of effective budgetary control. Number one, there should be a clear demarcation between the areas of managerial responsibility. Now, the problem with budgetary control is you prepare a budget and then that has to be implemented. And if you're not able to implement, or if we fail to get the desired result, you should know whom to talk to. For this, you have to first clearly assign the responsibility, clearly have one single spreadsheet with all the responsibilities and assign that to individual A, B, C, D. So at the end of the year, with that same Excel sheet, you can assess the individual performance. If you just allow team A, team B, team C, or this division, that division, production manager is responsible, then one production manager cannot drive everything in the organization. You need to clearly mention the responsibility of every individual to achieve the target or to achieve the budget. Budget target should be reasonable and capable of being achieved. If you set an unreasonable target, you know very well what is going to happen. Nobody will achieve, and then end of the year you will have huge variances, differences, and you will cry, no one is achieving. It was wrong from your end that you have set such unreasonable numbers. There should be proper data collection, analysis, and reporting techniques. As I told you, once in a month, once in 3 months, you need to collect the actual data, compare, analyze, and come to a conclusion. For this, you need to have a detailed database within the organization. Okay, just 1 second. Yes, let's continue. Variance report should be generated in a timely manner. Now, variance report is a report that compares budget with actuals. Now, this report, when they say timely, they did not mention, but we should know that we can't be doing it randomly. We should have a system that once in a month, at the end of the month, once the actual data is available, within 5 days, we prepare a variance report, then we discuss with the respective departmental heads, the meeting is conducted, actions are taken. You need to have a clear timetable, a proper calendar. Otherwise, you will not be able to have an effective budgetary control system. The reporting periods should be shorter, appropriate for the entity, generally a month. They did not say always, but it is better if you have it on monthly basis. You can't do it on weekly basis. Practically, it is difficult. Advantage of doing it on monthly basis is you have enough time to correct your mistakes. If you do it once in 6 months, then half of the year will be over by the time you realize what is going wrong in the organization. First month, second month, third month, when you do, you have a scope to improve. You have time to correct your faults. So most of the companies, that's why they do it on monthly basis. Report should be aimed at individual managers rather than having general information. I already told you, you need to have a clear demarcation of responsibilities, and your budgetary control system, your variance report, the analysis, everything should happen at individual activity, individual manager, individual department level, nothing in totality. There should be an attitude of personnel to take reports seriously. This is a problem with culture. Many people do not consider this very seriously. Focus should be to get operations back under control if they are shown to be out. Full stop. It's not feedback. Feedback is actually the next heading. Shown to be out of control. Yes. So focus should be to get operations back under control if they are shown to be out of control. Suppose we are spending too much. See, 2, 3, 5% variation from the budget is quite common, is quite accepted by every company, everybody. But if you have 30, 40, 50% variation from your budget, then there is a need of involvement of top management, individual, immediately they have to sit and fix this problem. Two types of control. Number one, feed forward. Sorry, I think this heading should have come here. Yes. Yes, this is feedback and this is feed forward. So the heading has wrongly come here. Yes. What is feedback? It measures measurement of differences between planned and actual outputs, the subsequent action and or plans to achieve future required results. It compares historical result with budgeted results. Feedback information is from system outputs or outcomes. It is primarily a corrective control. Mark this important. Feedback is a reaction after an action takes place. So there has to be an error to take an action. Understand, feedback control, the name itself tells you our budget, our actual, and now there are a lot of problems, adverse variances. Now you sit and find out what went wrong. Why did we do this mistake? How should we fix this in future? Feedback. They say it compares historical result with budgeted result. That means the month is over. Historical result means actual. The month is over. And now we are sitting and comparing the budget of the month and the actual of the month. The budget was prepared 2 months back. Actual is for the previous month. And now there are so much of differences. Here, see this. It is primarily a corrective control. Why is it a corrective control? Suppose now we are in the month of October. We have the September month budget with us, September month actual with us. Today, if we sit and compare everything, review everything, what can we do for the September excess cost? We can't do anything because September is over. That's why they say it's a corrective control, because the September month is already over. Whatever you can do, you can only do it in October. Some companies do one more mistake. If they do the review of September data in the mid of October, or say after mid of October, say 20th October, then it will be too late for you to even do something in October. Not just September is gone, even your October is gone. But if you do the review in first 3-4 days of the month itself, you will still have more than 90% of the new month in your hand. You can take immediate actions. Yeah, so this feedback is a reaction after an action has taken place. September month is over. Lot of employees have wasted a lot of materials. We have purchased poor quality items. We wasted a lot of time, labor, unused during the month. Everything is done. And now you will sit and analyze why that happened. And now you are thinking how to fix this in future. That means an action has already taken place and now you are reacting to it. So there has to be an error to take an action. That means as long as you're getting nil variance or favorable variance, you will not do anything in feedback control. In feed forward control, what you do? Forecasting of differences between planned outcomes and implementation of actions before the event to avoid such differences. We are still in the month of September itself. Imagine this way. Second example. We are still in the month of September itself. We have the September budget with us. Today is September 10th. September actuals will come after September 30, but I am thinking, looking at the ongoing scenarios in the market, September cost may be higher than the budgeted cost. Now, September is not over. September is just 10th today, 10th, 11th of September. I'm already expecting that my actual cost of September to be higher than the budgeted cost. This is called forecasted cost compared with budgeted cost. See here, compares the difference between budget and forecast. Here in feed forward system, it is primarily obtained from the external environmental changes. I told you there is a problem in the market. We are not able to get the supply of raw material. Today is September 10. I'm already worried September 20 whether I'll get raw material at the old price or not. Why? There is a problem in the market. There is a demand supply shortage, or there is a transportation issue, or there is a flood in one of the state and all my raw materials have to come from there. Now the transportation has been disturbed very badly. I don't know whether I'll get it or not. And if I don't get, what I have to do? I have to buy from someone else, and that price, purchase price, will be much higher than the price that I'm already paying. I think September month I will have higher material cost. This is called feed forward. September is not over yet. You're already thinking that you'll be spending little more. It is a preventive control. Now on September 10th itself, I'm thinking, how should I avoid this extra material cost on September 20? Can we talk to another alternate supplier today itself, not wait till 19th or 20? Or can we talk to our regular supplier and try to get some material at least much earlier than 20? Because flood has as of now created a problem. Talk to them. Try, is there any other alternate way we can get it from them? Do they have another branch or another warehouse in some other place where there is no flood? Can I get from there without any delay at the same price? Try doing something on September 10 itself. So September 20, you are in a relaxed zone. This is called feed forward. It involves measuring the amount of error before it has actually taken place. I am thinking we may waste a lot of material. I'm expecting my material cost may go up. I'm expecting some labor may be idle. They may have free time at the end of the month. And I start taking the preventive actions now itself on September 10th itself to make my balance September better. September 11 to 30 should be better. That is my objective. Yes. Type of feedback in budget. One of the important things is you talk to the employees. By the way, please mark this section important. Feedback control and feed forward control. Yes. Type of feedback. First one, positive feedback. It is taken to reinforce a deviation from the standard. The input or process is not altered. A feedback has been taken, but we're not changing anything. Second one is negative feedback. It is taken to reverse a deviation from the standard. It involves amending the input or process so that the system reverts to a steady state. Primary and secondary, again, two more varieties. It is reporting to the immediate line of management in the form of control report, comparing the actual with budgeted. Secondary feedback, it is the feedback sent to the higher level in an entity and can lead to a plan being reviewed and possibly even changed. So the primary feedback is taken at an operational level by the machine worker, by his supervisor, by the immediate manager. Secondary feedback is the feedback that is given to the top management that may create a big change in the overall budget itself, may have to change the overall company's policy itself. Unless the matter goes to the top level, understand overall policy level change will not happen. All of this, taking feedback, doing feedback control, feed forward control, all of that is easy on paper. But when you have to bring in this, there are a lot of behavioral challenges, behavioral problems. Number one, budgetary control involves both evaluation of managers as well as motivation of managers. Both these aspects, evaluation versus motivation, are mutually contradictory. Many times you want managers to perform better and managers want you to remunerate them well. You means management. Manager here means the operation heads. The top level management, they want every manager, every employee to perform better and better and better. Now that employee on the other side is not motivated enough to perform better and better and better. He thinks he's not paid well. He's not happy with the job. He's not seeing growth. He's not learning anything. Unless these things are taken care, he will have no motivation to work well. So there is always a contradiction between what management is expecting from employee and employee is expecting from management. If these 2 points meet, then you will have a very, very successful budgetary control system. But 99% of the cases, these two will not happen. In simple, what boss wants from you and what you want from boss, these two things have never met so far. Same problem even in future. Second, managers cannot be held responsible for factors over which they have no control. Hence, use of control reports and variance may not have the desired effect for evaluation of the performance. You cannot blame purchase manager because he is buying at a higher price. He will say, I am buying at a higher price because there is a problem in the market. He says, because of Russia-Ukraine war, my supplies has been disturbed. Now, what can the purchase manager do if the prices of the raw material has gone up because of Russia-Ukraine problem? So whatever happens during the year, he says, look, boss, I'm not able to achieve any target because of problem in the market, and problem in the market is because of Russia-Ukraine war. This is totally outside his control. Now, even top level management cannot do anything. Yes, if the standards are too unrealistic, they cannot be achieved. Managers may find the budget too challenging and therefore reduce their effort. Many companies fail because of this. The top level management, they set unreasonable expectations. And because there are no reasonable expectations, the ground level employees, the operation level managers, they know very well from day one of the year itself, they are demotivated because they know they will never be able to achieve this target, because they keep shouting, this is not the correct number, this is unimaginable. Nobody can ever reach that target. I don't know what our top managements are thinking of. And if this happens from day one, he'll have no energy, no motivation. So he will never achieve even 70-80% of an unreasonable target. You give a reasonable target, that means you bring down the target and come up with some incentive. If he crosses 100%, then there is a chance. Example, one target given to one of the production manager is that we should produce 10,000 units from one machine every day, from one machine per day. And as of now, how much are we producing? 4,800 units. Now that production manager says, sir, this is unreasonable expectation. How can I increase the production more than 100%? And he knows from day one that he'll never be able to achieve this. So he will never try anything. But instead of keeping this, if you bring this 10,000 units to 7,000 units, sorry, 10 extra. If you bring it down to 7,000 units and say, look, if you achieve 7,000 units, you will get 10% bonus. But in case if you exceed 7,000, if you go more than 7,000, for every extra 1 unit you produce beyond 7,000, you will be given 5 rupee incentive. Now, there is a high chance he may even cross 7,000. Not only that, he will surely achieve 7,000, because for him from 4,800, 7,000 looks doable. But because he has such a fantastic incentive possible beyond 7,000, he may go beyond that. Now, once he goes beyond that, suppose he produces 7,200 units, you will first give him 10% bonus as per the agreed incentive plan, and also give him 200 units into 5 rupee, 1,000 rupee extra. Now you know that he is capable of producing 7,200. Next year, you will set his target as 9,000, and same way, if he crosses 9,000 units, on each unit, you promise him to pay 10 rupee. Now what happens? He will definitely try to go till 9,000, because now he himself has achieved 7,200, so he knows his capabilities. Correct? But first year itself from 4,800, if you say 10,000, he will never show interest because he knows that is unreasonable and can never be achieved. lot of the targets or the budgets fail because the standards are so unrealistic, and managers, because they find it too challenging, therefore they will reduce their effort because they know how much ever I do, I can't achieve this number. Why to even put extra work? Allowing managers to set their own goals, budget may lead to creation of budget slack, that is targets which are easily achievable. If you give them an option, if you ask managers to set their own target, or you set a target and allow them to make 5-10% modification, they will always make such modification to their convenience. If you say you can increase or decrease the budget by 10%, this is our target production, they will always decrease it by 10% only. They will never increase because you have created that opportunity. Budget slack is the scope for marginal up and down correction, 10% up or 10% down. If you allow them to do, they will surely do it. Budgets may distort the entity's long-term goal since they will be focused on short-term cost reduction rather than quality aspects. Obviously, now if you try for one, you'll have the problem on the other side. You tell him that by the end of December, our number of units per machine per day should cross 7,500. He'll be more worried about fast production, quick production, because his target date is end of the year. He may not focus much on the quality. And when he is not, he means the manager, when he is not focusing on the quality, now customers will have a reason to be worried about. And then management will have to sit and spend a lot of money on defectives, rectification, all of that. Loss of goodwill also is another point. Budgets give more focus to financial aspects. They ignore non-financial factors. Lack of coordination between departmental manager makes the budget process ineffective. If every manager is thinking of his own goal, his own achievement, his own incentive bonus, he may not be worried about the overall company, and he may start having conflicts with the other departments, similar to the transfer pricing problem we discussed some time back. Budgetary process harms managerial initiatives and may create false sense of security. There may be conflict in the overall entity's goal and departmental goals. I've covered all these points actually. Budget that motivates the best level performance may not be achievable. In contrast, budget that is expected to be achieved motivates a lower level of performance as managers no longer aspire to meet budget target. I told you from 4,800, don't keep 10,000 as the target because it is unreasonable. But from 4,800, if you just keep 5,500, then everybody will achieve. Even that is of no use. So it should be reasonable, but not easily achievable. It should not be unreasonable and beyond humans' achievement. It should be, finding that exact point is where the problem. It should be reasonably challenging, but not too impossible. And for one employee, it may be achievable. Another employee, it may be, unimaginable. It is possible, correct? That same machine, 2 employees, 4,800 units as of now, you give 7,000 as the target to both of them. One guy may say, okay, challenging, I'll try. Another says it is impossible. It is very, very subjective. If goals are not clearly defined in the budget, the person in charge of implementation may get confused and may not know how to implement the same. This is the problem of communication. The manner in which accounting measures provided by an accounting system are interpreted and used for performance evaluation has an impact on the overall budgetary evaluation, because budget is prepared based on cost accounting techniques, whereas actuals are prepared by financial accountant. They use their trading and P&L account. Now the cost accounting policies of treating an item and financial accounting policies of treating an item may be different. Now, because of the difference in the treatment of an item, it may become difficult for the management to compare the performance. I'll simply give one small example to you. In cost accounting, inventory is always valued at cost, but in financial accounting, it is cost or NRV, whichever is less. Now, if you want to compare budgeted cost with actual cost, the cost comes after adjusting the stock. In cost accounting, that is when you set the budgeted annual cost, your inventory was estimated on cost. But if the NRV is lesser than that, the actual information, the financial accounting information, will take a lower closing stock. Now, because of the lower closing stock, now you know their cost, that is financial accounting cost, and the budgeted cost, which is based on cost accounting, may not match. If your policies are different, if the base number itself is not match, not comparable, then the whole budgetary control system will go for a toss. Correct? You need to have same method of depreciation in budget and in actual. You budget one method, later in the actual, company decides to change the policy of depreciation, method of depreciation, then your budget can't be compared with actual. Inventory valuation, another example. Lot of items, like how to treat a particular item in costing and how to treat that in financial accounting. If there is a difference, then understand your budget and actual numbers cannot be compared. Yes, another very important part of this chapter, approaches to budget. Top down, which is called imposed style, bottom up, which is participative style. First one, top down approach. Budgets are prepared centrally and subordinate level managers have very little influence on target setting. That means top management, board of directors, they decide the budget. The bottom level managers, the subordinates, the ground level employees, they have no involvement in budget preparation. This is preferable if a process is highly programmable and has clear and stable input-output relationship. Then whatever top management thinks is the same thing that even divisional managers be thinking about. If a firm has a large number of homogeneous units and operating in a stable environment, you produce only one unit, only one product, only one variety, then making the budget is easy, implementing that also is easy. Suppose my company makes only and only one variety of calculators, no variation in product, no variation in pricing, nothing. Same calculators is what we make. Now, whether the top level management only they do budget, I'm sorry, just give me 1 minute. I'm sorry. So when the company is making only one variety of product, more number of units, but same product again and again and again, when they make, it becomes easy for both top level management and the subordinate level managers to sync in their objectives. It is always easy because I make only one variety product. Last year we produced 10,000 units. This time, even the employee at the very lowest level, even he will know how much is going to be the budget, because we know our market, we have an infrastructure set. There are no too much of ups and downs in our business. Our product is only one variety. Things become much easy. Here you can use top-down approach. If personality characteristic of the participation may limit the benefit of participation, example conflict, bickering, etc. If participation by itself is not adequate in ensuring commitment to standard, and managers can significantly influence the result. Most of the times what happens, the subordinate level managers are unhappy that they are not involved in the budget making process. But if you involve them, they're not in a position to bring in valuable inputs to the table. So their participation is just mere physical appearance in the meetings. They're not in a position to understand the way the top level managers are thinking. If this thought process is not syncing up well, you will not be able to add any value, though you are physically sitting in the budget meeting room. And this is what happens in most of the times. The subordinate managers believe that they're not involved, and when top managers involve these subordinate managers, they're not able to give valuable inputs. It will just be a physical presence, a physical participation, but nothing in reality. See this, that's what I told you. If subordinate level managers lack the level of understanding to participating in budget setting process and are merely doers than planners. If that is the case, then there is no use of involving them. Your company can follow top-down approach itself. What is bottom-up approach? Here, you ask every employee, every subordinate manager to submit what he can achieve. And top managers only collect data from all the employees, and then they summarize all of that, and then the budget is prepared. See this, that's why they call it as participative budget, because this is not decided by top management. This is going from bottom to the top. Subordinate managers participate in the preparation of their own budget. Every department will come and set a target for themselves, come and give a budgeted data to the top management. These budgets are then reviewed by senior management. Factors influencing the effectiveness of participation is personality, type of organization structure, work situation, locus of control, job difficulty. Obviously, it is easy in textbook to write that participative budgeting is always good. Everybody is setting their own target and company is not forcing anything. Understand the biggest problem. If you ask the subordinate managers to set the target for themselves, they will always make it easily achievable. They will make it in a manner that is convenient to them. And they will look at only their objective, their department, their performance. They will not look at company as a whole. And when that happens, the top managers, when they receive budget inputs from all these subordinate managers, they realize, okay, look, these guys have a different attitude altogether. They don't want to work hard. They don't want to bring in new ideas. There are no fresh air coming to the budget making process. These guys are just doing the same copy paste work. If that is the case, then why should we have participative budgeting? Understanding? Most of the times it is easy to say participative budgeting is more scientific, but in exam you should always write the challenges. They may not have the level of understanding, the lack of quality to be, a leader in the company. If you have that, lack of quality, then as a subordinate manager, you will only think about, 2% of the overall company. You'll never be able to visualize the bigger picture. So all your inputs, you finally say, though they called it as participative budget process, we submitted all our numbers, but none of the numbers submitted by us is actually reflecting in the final budget. You will definitely be unhappy because you do not have that quality to think like a leader. This is what they said, the personality problem. Different style of management. This I already told you, budget constraint, conscious style, and non-accounting style. Not so important. Let's move on. The next one is limitation of traditional budgeting. Traditional budgeting is whatever we have been doing. Not strategically focused on long-term goals, often contradictory, time-consuming, lack responsiveness and flexibility, creates barrier, does not add much value to the organization, create departmental barriers rather than knowledge sharing, updated too infrequently, that is once in a year. Most of the companies, they follow a traditional budgeting style. You prepare annual operating plan once, that is for the whole year, and the review is done once in 6 months. or once in a year, and then they prepare the next year annual operating plan. This is the traditional way of making the budget. Therefore, the solution to that is beyond budgeting. Mark this concept, very important in budget. Whenever they ask a regular budget question, they can ask a sub question on beyond budgeting also. Mark it important. Meaning, beyond budgeting is a leadership philosophy that relates to an alternative approach to budgeting, which should be used instead of traditional annual budgeting. Second, beyond budgeting, it is beyond budgeting is an idea that companies need to move beyond regular budgeting because the inherent flaws of budgeting, especially when used to set contracts. It is argued that a range of techniques such as rolling forecast, market-related targets can take the place of traditional budgeting. The big problem with traditional budgeting is, listen to me, how do you prepare next year budget? Most of the times the answer is depends on this year achievement and last year budget. So your year 3 budget is always based on year 2 budget and year 2 actual. Based on this only you make year 3 budget. Most of the companies do it based on year 2 actual, not even year 2 budget. So in year 2, our actual numbers are say 10,000 units. That means year 3, we will say, okay, we should grow at least 5%. So let us keep a target of 10,500 units production per day, 10,000 to 10,500. The biggest problem of traditional budgeting is you're always looking at the past and then preparing the budget for the future. How much did we achieve last time? Plus 5-10% growth. Beyond budgeting says, look, you need to set the target based on the market related factors. Everyone else in the market, every other competitor of you, they are producing 11,500 units per day. And you're still saying last year ours was 10,000, therefore our target is 10,500. This has a very, very basic fundamental requirement to rethink the way budget is prepared. You cannot say last year 10,000, therefore 10,500. Why don't you benchmark yourself with the best practices? Everyone is producing 11,000 every day, 11,500, 12,000. Why don't you think that way? Beyond budgeting is making your budget not based on past year performance, but based on the market factors. If I produce 10,500 every day, is that enough? I'm expecting the demand to go up. How are my competitors coping up with increased demand? They are producing 12,000 every day. Why am I still talking about 10,000, 10,500? I know with 10,500 I'll not be able to meet market demand. Demand is high. And to cope up the demand, others are increasing the producing. Why am I still talking about old numbers? Let me set the target based on market. Let me also try and achieve 12,000. Now you go back and think how you can improve production to 12,000. That means now your budget is totally based on market factors, best practices, competition, and that is how the budget should be prepared. Otherwise, 10,000, based on 10,000, you make 10,500. Next to next year, what will you do? Based on 10,500, you will set 11,100. After that, based on 1,100, you will make it 11,650. So all your budgets will be based on past. I'm sorry. But the market-based goals, market-based targets will not go by your historical performance. Some of the features of beyond budget. See this. Focus on managers' shift to improving future results and not merely compliance with the budget. In traditional budgeting, guys, just 1 minute. Guys, I'll come back in 1 minute, please. Yes, I'm sorry, having a bit of cough. Yes, let's continue. The biggest weakness in the traditional budgeting is managers focus on only one thing. Look, my budget was this many units. I should achieve that many units. There is no use in producing more than that. So as long as a subordinate manager is in a position to achieve the target, he will be happy. He will never think of going beyond that. See, name itself is beyond budgeting. Target given to you was 10,500 units every day. 10,500 units every day. In traditional budgeting, what happens? If he achieves 10,500 units, he will be happy because he has met his budget, he has met his target, enough for him. But beyond budgeting says, look, 10,500 units is a target given to you. Try and see, is there a scope for you to exceed this also? Don't just be happy by meeting the target. Traditional budgeting says, if targets are achieved, company is happy, top management is happy. But what beyond budgeting says, no doubt, the target was 10,500. Can you try and achieve more than this? Yeah, so this focus of managers will shift from improving results, improving the future results, and not merely complying with the budget. Okay, 10,500 was the target. Can I try 10,600, 10,700? This is called beyond budget. Rolling budgets may incorporate KPIs. Benchmarking can be incorporated in budget. I told you, you can learn from good practices in the market, in the industry. Why to just restrict yourself to last year number plus 5% up? Why don't you think of the best practice, benchmark that, and try to achieve, say benchmark is 12,000, best practices, they're able to produce 12,000 units in a day. Why don't you also try and produce so much? Suitability. Where beyond budgeting is suitable, industries where there is rapid change in the business environment, in such case, you can never follow traditional budgeting system. You have to be in a position to redo budget 100 times in a year. You have to think much outside the paper, the quantitative budget. Second, industries using management methods such as total quality management, TQM, we have already discussed. Industries undergoing radical changes, example, business process re-engineering, where your competitors are coming up with new ideas every now and then, new products every now and then, new feature in the product every now and then. You can't prepare one budget for the whole year and try to achieve only that number. You have to redo, re-prepare, revise your budget depending upon the market condition. Benefit, better coordination, elimination of behavioral issue, allows operational managers to react to the external environment, encourage culture of innovation, more timely allocation of resource, more adaptive process, decentralized process, helps in motivating individual by defining clear responsibilities, create information system, and establishes customer oriented teams. Easy points, most of it is general in nature. Some basic principles. Number one, process principle, goal, reward, planning, control, resource, and coordination. Leadership principle, customer accountability, performance, freedom to act, governance, and information. Again, general in nature. Implementation of beyond budgeting. Number one, define the case for change. What we were doing in the last year, why we should change the way we were doing things. First, you have to bring in a detailed explanation that, look, we were producing so much, and according to me, that is not the correct achievement. We need to achieve much more than that. Convince the top management. Get started. Now try. Last year was 10,000. Don't go with just 5% over 10,000 extra. See what others are doing. Benchmark yourself. Try understanding how they are producing. Get started. Design and implement the new processes. You now know if you go by your regular style from 10,000, you can only come to 10,500. But your target in beyond budgeting is not to be happy at 10,500. Your target is to try 12,000, the best practice. Train and educate people. Otherwise, they will just go in their regular style. You will never go beyond 10,500. rethink the role of finance also, change behavioral aspect, evaluate the benefits, consolidate the gains. Role of budgeting. Budgeting is evolving rather than becoming obsolete. It depends on the trust and transparency. Forecasting and use of specific tools for this purpose has become more important in budgeting. Shift from top-down centralized process to more participative and bottom-up approach. This is the trend that the top management will not decide what everyone should do. Everyone should first communicate what is that they can do, and then it is all consolidated by the top management. Top management may not directly accept whatever is supplied by the bottom level employees. They will definitely make a lot of modification, but at least everybody would feel that they are also participating in the overall process. Thrust to shed the rigidity associated with traditional budgeting. It highlights the level of improvement that can be achieved even with relatively simple modification and great deal of trust. There is a gradual shift towards incremental improvements with traditional budget being supplemented by new tools and techniques. Easy points. Traditional versus beyond budgeting. I've already discussed this in last 15 minutes. All of that is given here in one single table. Target and reward. In traditional budgeting, incremental target, fixed incentive. Why incremental? Last year 10,000 units per day. This year plus 5% extra. Fixed incentive. If you achieve that, you will get bonus. You will get incentive. Here, stretchable goals. I am not saying only 10,500. Look, the best practice in the market, the number one company is producing 12,000 units per day. Can we try and achieve that? Relative targets and rewards. Now you will set the incentive based on the achievement up till 12,000. Every extra unit, there will be additional incentive and so on. Planning and control, fixed annual plan, variance-based control, continuous planning and improvement, KPIs and rolling forecast. Resource and coordination, everything is pre-decided, everything is pre-allocated, and decision is all done at central level. Here, resources are allocated on demand because you're not very rigid with your budget, and there is dynamic coordination from the top to the bottommost employee in the organization. Organizational control, I told you already, central and focus on managing numbers. Local controls focus on the value creation. Mark this table important. One day before exam, you can read this table. Very basic objective anyway, you know. Mark this important. Yes. Just give me a minute. I'm just checking the RTP for relevant question on the concept that we covered. Just a minute. Yes, there was a question on transfer pricing. Let me just share screen with you. Here it is. Transfer pricing question. Question number 6 in the latest RTP. ZAP has 3 divisions, Z, A, and P, which makes product Z, A, P respectively. For division A, only direct material is product Z, and for P, the only direct material is product A. Simple to understand, don't get confused. Division Z purchases all its raw material from outside, obviously. Direct selling overhead representing commission to external sales agents are avoided on all the internal transfer. This I discussed some time back. When you do internal transfer, there are no selling and distribution costs. But if you have to sell it outside, you have to pay commission to agents, and that can be avoided. Simple. Division A additionally incurs 10 rupee per unit and 8 rupee per unit on units delivered to external customers and P respectively, 10 and 8. A also incurs 6 rupee per unit picked up from Z, whereas external suppliers supply at A's factory. That means there won't be cost in picking it up at the stated price of 85 per unit. That means there is an option to buy even from outside. Simple. Additional data given. Direct material, external supplier rate, labor, sales agent commission. In this, you know, some are avoidable. Selling price, if you sell it outside, production capacity and external demand. Discuss the range of negotiation for manager ZAP for the number of units and the transfer price for internal transfer. Now you need to observe that's the end of the question. You need to observe here when you are writing the solution, first see the condition for Z, A and P, the production units and the external demand. For example, let me talk about Z. You can produce 20,000 units, but you can sell only 40,000 units. That means the balance 6,000 you have to transfer internally. Correct? Now you have less bargaining power on the balance 6,000. Because there is no choice. You can produce 20,000, but you can sell only 14,000 outside. So 6,000 extra, what you will do? You will have to transfer internally. Now you can't say, I will transfer only at the market price, because the receiving department will then say, boss, if that's the case, then you go and sell in the outside market. You can't sell all 20,000, only 14,000 can be sold. For 6,000, you have a lesser bargaining power. Look at A. They can produce 30,000, but they can sell only 26,000 in the outside market. Now also their bargaining power for the excess production is less. What about P? Their production capacity is 40,000, external demand is 42,000. Now there is no question of bargaining power, because P has to finally sell it to outside customer. And here customer demand is 42,000, but P can produce only 40,000. That means you will not be able to achieve full target. That's the only problem for P. There is no negotiation that P has to do with an external guy. The external guy is a final customer anyway. So this is a simple question, easily doable, not much of a difficulty. You will have to fix separate transfer price for what you're going to sell, not transfer price, separate price for what you're going to sell outside and for the balance. And for Z also, there is 6,000 of excess production. For A also, there is 4,000 of excess production, and their bargaining power comes down when they have excess production. Yes, so this was the question on transfer pricing. I'll just scroll down to the solution part. We'll quickly take you through that as well. Just a second. Question number 6. See this. The answer doesn't involve too much of calculation. You can see end of the answer here, only this much. Because here it is completely based on the bargaining power. Correct? They have given division A, division P, and division Z, all the numbers. Very, very easy question. I've gone through both the question and the solution. You can also go through after the class. Yes, coming back to the RTP. I'll just see if there is any other question that can be discussed. Ethical and non-financial, I will discuss in the next session. Supply chain is to be discussed. Again, ethical and non-financial. Performance measurement question. This is based on standard costing. I'll be doing it a little later. Ethical dilemma, again, non-financial. I will discuss later. Transfer pricing, I discussed. Cost of quality, this is already covered. Special order decision, this will be taken care in the next session. Life cycle also. CVP analysis is a very easy question. Those who have attended my regular class, we have already done this sum. Yes, you can go through this. Balance scorecard, we already covered it. Pricing decision is a very simple question. End of the RTP. So coming back. So we have completed up to budgets and budgetary control. Yes. So in the next session, I'll be discussing strategic analysis of operating income, and we will discuss all the balance topics as well. Okay. After this, I'll be going to standard costing and then CVP analysis, decision making, and also we will cover pricing decision. Pricing decision is actually an extension of CVP analysis. So we will cover all of that and also discuss the balance questions from the RTP. Okay. Thank you so much. We will catch up in the next session. We will start from ABC and complete all the pending topics and RTP questions. So see you in the next session. Bye bye.